Are you looking at a stock riding a massive 41% year-to-date wave to redemption, or are you staring at a masterfully disguised value trap?
Yeah, that is the literal billion-dollar question today.
Right. I mean, we're looking at a scenario where massive short-term momentum is just colliding head-on with fundamentally terrifying balance sheet metrics.
Oh, absolutely. It's a completely wild setup.
So we are going to figure out exactly what is happening under the hood of Plug Power Inc., trading under the ticker PLUG. As of today, which is April 13th, 2026, it is sitting at $2.77.
Up just over 1% on the day, right?
Yeah, exactly. Up 1.09% to be precise. But before we tear into the mechanics of this market paradox, take a second to subscribe to our feed and leave your feedback in the comments. It is absolutely compulsory to share your thoughts with us.
We really want to know how you are reading these conflicting signals because, I mean, it's a lot to process.
Okay, let's unpack this. To understand the stock price, we really have to look at the engine first. And the financials for fiscal year 2025 highlight exactly why institutional caution actually exists here.
Yeah, you look at the top line, and they brought in nearly $676.17 million in annual revenue,
Right, with the fourth quarter accounting for roughly $225 million of that.
which sounds great on paper, you know. But the cost of generating that revenue, that is where the fundamental thesis really starts to crack open.
Oh, it cracks wide open. I mean, they posted an annual net loss of roughly $2.12 billion.
Billion with a B. Yeah, it's staggering.
The fourth quarter alone bled out over $845 million. That dragged the trailing 12-month earnings per share down to a negative $1.42.
And, you know, the sheer scale of that net loss highlights the structural bottleneck of the entire green hydrogen industry right now. It's not just this one company.
How so? I mean, a $2 billion loss is uniquely massive, isn't it?
Well, yeah, but when a company scales hardware manufacturing and physical energy infrastructure at the exact same time, the capital expenditures are just astronomical.
Right, because they aren't just building like a software platform that scales infinitely.
Exactly. They are fabricating physical electrolyzers, securing logistics networks, and essentially subsidizing the adoption curve for their clients.
So the more volume they push, the more cash they just incinerate.
Yeah, for years that was the reality. The fixed costs of scaling completely outpaced the variable profits of the hydrogen itself.
Wow. But buried in that massive Q4 loss is this tiny, highly specific data point that the bulls are clinging to right now.
Oh, the gross margin?
Yes, for the first time ever, they actually posted a positive gross margin in the fourth quarter. I mean, it was only 2.4%.
Right, which represents about $5.5 million in actual gross profit.
Yeah, a drop in the bucket against an $800 million quarterly loss, but it crossed the threshold from negative to positive.
What's fascinating here is the tension between that tiny positive margin and the overall massive net loss. That threshold is a huge psychological and operational milestone for an infrastructure company.
Because it proves they aren't just giving the product away.
Exactly. A positive gross margin proves the underlying unit economics are not entirely fictional, right? It demonstrates that the raw materials and direct labor required to produce their hydrogen systems finally cost less than what the end customer pays.
So the assembly line itself isn't a total lost cause.
Right, but gross margin only covers the direct costs of manufacturing. I mean, it does absolutely nothing to service the massive debt load or the administrative overhead or, the research and development.
Which brings us to the survival metrics, right?
Mm.
Because a positive assembly line doesn't mean the corporate entity avoids insolvency.
No, not at all. Let's look at the balance sheet. They have $368.54 million in cash and equivalents.
Okay, and total assets.
Total assets sit at $2.59 billion against roughly $732 million in total debt.
So with a current ratio sitting around 2.31, the textbook interpretation is that they have plenty of short-term liquidity, right?
That's the textbook grade, yeah.
But, I mean, it's like a sports car that looks amazing on the outside, but it's just hemorrhaging oil from the engine block.
Yeah.
A current ratio is just a snapshot in time.
Exactly.
If their operating cash flow is bleeding at negative $148.64 million a quarter, that liquidity evaporates in a matter of months, doesn't it?
Yeah, that current ratio of 2.3 creates this huge false sense of security for anyone just skimming the top-level metrics.
Right.
When your operating cash burn is that severe, the cash pile is essentially just a ticking clock. Without alternative financing, that $368 million gives them a runway of maybe 2.75 max.
So let me ask you this. With a 52-week range from a dismal 69 cents up to $4.58, how much of this recent price action is actual business recovery versus just avoiding bankruptcy?
Well, the market knows about that ticking clock. That's exactly why the stock capitulated down to that 52-week low of 69 cents.
So this recent rally back up to the 270 range.
It wasn't driven by sudden profitability. It was a survival rally. It was literally just the market pricing out the threat of immediate, next month bankruptcy.
Wow. But if the fundamental cash burn is acting like gravity on the valuation, the technical indicators are basically defying those physics right now.
Oh, completely. The charts are wild.
The stock is up roughly 19% over the past month, and retail traders are looking at a setup that is aggressively bullish.
Yeah, across various time frames, the stock is currently flashing 12 distinct buy signals on its moving averages.
Right, spanning from the 5-day all the way to the 200-day. The 5-day moving average is sitting at 2.398.
And with the stock trading at 2.77 today, it is holding comfortably above that short-term trend line.
So momentum traders are just jumping in.
Oh, yeah. They're capitalizing on a heavily oversold bounce that triggered a lot of algorithmic buying. I mean, look at the 14-day relative strength index.
The RSI, where is it sitting?
It's currently at 65.5, so it's nearing that overbought territory of 70, but there's still mathematical room for upward momentum. It's still flashing a buy.
Yeah, the MACD.
The MACD is sitting at a bullish 0.044. That crossover confirms the short-term trend is firmly in the hands of the buyers right now.
Yeah, and the buyers certainly built a rock-solid base of support during the recent consolidation, right?
Yeah.
Defending that $1.80 to $2.10 range.
They did on heavy volume, too.
But now they are staring straight up at a massive psychological resistance wall at $3.
Yeah.
And even if they break $3, there's this huge historical graveyard of selling pressure lurking between $3.40 and $4.30.
Yeah, that graveyard is what we call overhead supply.
Right. So the technicals are screaming go, but the financials are flashing red. It's like the GPS is telling you to accelerate, but your fuel gauge is on empty.
That's a perfect analogy because when a stock precipitously drops from $4.58 down to 69 cents, it traps a massive cohort of buyers who bought the top.
And they're just waiting to get out.
Exactly. As the stock rallies back toward their initial entry prices, those trapped buyers just use the momentum as an exit strategy to break even.
So you have technical momentum pushing higher, running directly into a wall of desperate bag holders.
Yeah, momentum can push a stock through resistance, but only if the underlying fundamentals give new buyers a reason to absorb that heavy selling pressure.
And when we look at how the institutional analysts are measuring those fundamentals, the broad consensus is firmly a neutral or hold rating. Wall Street is just sitting on its hands.
They really are. Though we did see Susquehanna raise their price target on April 9th, 2026.
Right. They bumped it from $2.50 up to $2.75. But the broader one-year target estimate across the analyst community sits at roughly $2.83.
Which basically implies almost zero upside from today's price.
Why is Wall Street so tepid when the technical rally is this strong?
Well, institutional risk models are highly allergic to the exact profile this company currently presents.
Because of the cash burn.
If we connect this to the bigger picture on a purely intrinsic basis, if you model out future global hydrogen demand and apply a standard revenue multiple, the stock actually looks deeply discounted.
Okay, so there is value there.
But institutional models factor in a value score. And currently, this stock scores an abysmal 2 out of 10.
2 out of 10, yikes.
Right. Funds managing billions of dollars cannot confidently deploy capital into an equity that just posted a $2 billion annual net loss.
Yeah.
I don't care how bullish the MACD looks on a daily chart.
Yeah, they require visibility into future cash flows.
Exactly. And right now, the visibility is heavily obscured by that quarterly cash burn. They hate consistent net losses and high volatility.
Here's where it gets really interesting, though. This friction between the technical charts and the institutional models is driving a massive debate among retail traders.
Oh, the forums are completely split on this.
Totally. You have one camp arguing this is an undervalued opportunity of a lifetime, right? A chance to buy a foundational green energy company at a deep discount. And the other camp argues this is the ultimate retail value trap.
And the trap argument has a lot of weight. It hinges heavily on downside risks and the psychological phenomenon of price anchoring.
Price anchoring, like looking at old highs.
Yes.
Yeah.
Retail traders pull up a one-year chart, they see the 52-week high of $4.58, and they anchor their valuation to that peak.
So they see the current price of 2.77 and assume it is intrinsically cheap simply because it used to trade higher.
Exactly. But a historical stock price is completely irrelevant if the fundamental capital structure of the business has deteriorated since that high was established.
Which brings us back to the survival mechanics and the cash flow. To fund that $148 million quarterly operating deficit, they have historically relied on heavy share dilution.
And dilution fundamentally alters the math of price anchoring. This is why retail traders get trapped.
Because the pie is getting cut into smaller slices.
Exactly. If a company issues millions of new shares to raise liquidity, the market capitalization might recover to its historical high, but the individual share price will not.
Right, because the underlying value is spread across a vastly larger pool of shares.
Yeah. Retail traders buying purely on momentum often ignore this persistent drag of dilution on their long-term stake.
And that capital raising environment is further complicated by the legal cloud currently hanging over the executive team.
The lawsuit.
Yeah. In March 2026, just last month, a securities fraud class action lawsuit was officially filed against the company. Now, we're purely analyzing this from a market mechanics perspective, but pending litigation of that magnitude severely restricts how a company can even operate.
It absolutely does. The operational restrictions are exactly why institutional capital flees from pending litigation.
Because of the distraction.
Partially, yeah. When a class action is filed, a massive portion of executive bandwidth is immediately diverted toward legal defense and discovery. But more importantly, it limits management's ability to issue forward-looking financial guidance.
Because of the legal quiet period.
Right. If the company cannot provide reliable revenue and margin projections, analysts cannot update their discounted cash flow models.
So the future becomes an unquantifiable variable.
Exactly. The risk premium placed on the stock skyrockets.
So I have to ask you and challenge you on this bit. Are retail traders just providing exit liquidity for larger funds right now?
What do you mean?
I mean, if institutions refuse to buy because of the lawsuit and the cash burn, but the technicals are flashing buy signals, are the big players just using this retail-driven momentum to quietly trim their underwater positions? Or is the intrinsic discount actually real this time?
That's a fair question. Framing it purely as exit liquidity assumes there is zero fundamental basis for a long-term turnaround, which kind of ignores the actual operational milestones the company is achieving.
Right, like that positive gross margin.
Yeah. It is highly likely that risk-averse institutions are reducing exposure right now. However, the intrinsic discount retail is chasing could be real if management executes a flawless strategic pivot.
Well, that's a big if.
A massive if. The danger is that retail traders are taking on institutional tier risk without access to institutional tier information regarding their internal cash management.
So to map out that risk asymmetry fairly, let's break down the ultimate bull case versus the ultimate bear case. We're not taking sides here, just laying out the scenarios.
Sure. Let's start with the bulls.
The best case recovery scenario is anchored in a massive narrative shift. The new CEO has explicitly pivoted away from the prior era of reckless, grow-at-all-costs expansion. The new mandate is strict, disciplined profitability.
And they have tangible wins to support that narrative.
Exactly. We already discussed Q4's first positive gross margin of 2.4%, but they also just secured a massive 275 megawatt electrolyzer contract in Canada.
That Canadian contract really changes the geometry of their future cash flows.
It's not just a speculative memo, right?
No, it's a binding agreement for massive physical infrastructure. A project of that scale provides long-term revenue visibility, lets them optimize their supply chain, and potentially secure project-level financing.
Financing that doesn't rely on diluting the parent company's equity.
Exactly. If the new CEO can enforce cost discipline while executing on these contracts, the bulls argue the peak cash burn is permanently behind them.
Okay, but the bear case counters with a stark reality. The gravity of the balance sheet is too massive for any single contract to overcome.
Oh, absolutely. The worst-case continuation lower is rooted in that unforgiving math.
The bears point directly at that $2.12 billion annual net loss and the looming March 2026 class action lawsuit.
Right, and they argue that the company simply does not have the runway to realize the revenue from these long-term contracts without aggressively diluting the current shareholder base.
because of the negative $148 million operating cash flow burn.
Yeah, you can secure the largest infrastructure contracts in the world, but if your working capital is insufficient to finance the manufacturing cycle, you are paralyzed.
So the bears are betting the company will be forced to print shares at depressed prices just to fund their legal defense and keep the lights on.
Basically, they think the positive gross margin will just be entirely consumed by rising debt service costs.
So where does this leave you, the listener, navigating this battlefield today versus tomorrow?
Interestingly, we are staring down a massive, highly unusual short-term catalyst.
We really are. The market is holding its breath for this one. On April 16th, 2026, CEO Jose Luis Crespo is scheduled to host a Reddit AMA and Ask Me Anything. Investors are eagerly awaiting this strategy update
Utilizing a Reddit AMA is a fascinating direct-to-retail investor relations strategy.
because it explicitly acknowledges that retail momentum is currently driving the equity.
Exactly. Bypassing the traditional institutional analyst, calls to speak directly to retail traders could act as a massive short-term catalyst, swinging the stock wildly.
What's the best case for the AMA?
If the CEO outlines a credible, non-dilutive path to funding operations, the technical momentum could easily shatter that $3 resistance wall.
And the worst case?
If the responses are evasive regarding cash flow management, the retail support could evaporate instantly.
Wow. And looking beyond the immediate volatility of this short-term catalyst, the long-term outlook remains highly speculative.
It does. The entire pivot depends on reaching positive EBITDA targets by late 2026.
Earnings before interest, taxes, depreciation, and amortization. If the CEO cannot generate positive EBITDA within that timeline, the narrative falls apart.
Yeah, and the technical momentum won't matter at that point. It is the ultimate test of management's ability to execute under extreme duress.
So to summarize this deep dive,
Yeah.
PLUG is the ultimate battleground between fierce technical momentum and fundamental cash burn. You have aggressive buy signals clashing with a staggering cash burn rate and institutional capital stubbornly waiting on the sidelines.
It's a high-wire act over a fundamental canyon.
It really is. And as always, this deep dive is for your education and entertainment. This is absolutely not financial advice. You have to evaluate how these conflicting metrics align with your own risk tolerance.
This raises an important question, though.
What's that?
If retail traders are purely buying the chart's momentum right now, and major institutions are waiting on the sidelines for those late 2026 EBITDA targets to materialize, what happens to the stock price if the CEO's April 16th Reddit AMA fails to deliver the magic words?
Yeah,
When that momentum breaks, who is actually left holding the bag?
that is a heavy, provocative thought to leave you with as we watch these two realities collide. Let us know how you think this specific catalyst plays out. Drop your analysis in the comments, and we will catch you on the next deep dive.